today's video, we're going to be going over vertical debit call spreads. Now I know that's a bunch of words put together, and if you don't know anything about these yet, that may sound a little bit confusing, but I'm here to break that down for you. So the first thing you really need to understand before you dive into these vertical debit spreads is what call options actually are. Now in a previous video, I did go over these in depth, so if you're already coming from that, that's awesome. If not, I'm going to give you a really quick summary. When you're buying a call option, you're buying the right to buy 100 shares of whichever stock that the call option is written for before whichever expiration date you choose. So for example, if you're buying an Amazon call option with a strike price of $3,100 and an expiration of September 31st, that would give you the right to buy those 100 shares of Amazon at $3,100 anytime before the expiration date, September 31st. With a vertical debit call spread, all you're doing is you're buying one of these call options and you're selling another one. More specifically, you're buying one strike price and then you're selling a strike price that's higher than that other one. When you're opening this trade, you're taking a bullish position. You need the price to actually go above that higher strike price that you bought in order for your profit to be realized. So now that you have that brief understanding, let's actually take a look at an example of this. So I have ThinkOrSwim open right here. ThinkOrSwim allows you to go back in time in the past and kind of test out strategies or purchases or anything like that. So I actually have July 24th at 9:45 open, and I opened Amazon here. You can see that the price of Amazon is right around $2,922 right now. Let's say we're bullish on Amazon and we think the price is going to go well above $3,100 sometime in the next week. It's currently Friday, so we would need to buy the next expiration, which is next Friday. If you think the price is going to go above $3,100, you would be looking at the $3,100 strike price. Now with a normal call option, if you just wanted to buy this $3,100 strike price, you can see right here, the price is around 59.00. And remember, due to our options contract multiplier of 100 that's implied, this would mean that the cost of the contract is about $5,900 to buy right now. So it's pretty expensive, and most people actually can't really buy that with a simple trading account. So this is one of the major advantages of vertical debit call spreads, is that we can play the 3,100 call on Amazon and hedge our risk a little bit, hedge our reward, and get into this trade for much cheaper. So what we're gonna do is actually buy the 3,100 call and sell the 3,105 call at the same time. Now in ThinkOrSwim, you can actually change this so you're looking at the vertical spreads. So if you change it at the top here from where it says spread single, you can go down to spread vertical, and then you can look for the one you want, so 3,100, 3,105, and then you can just buy it directly from this menu. Most brokers should have this option to search by vertical spread, but if not, you can always just enter a 3,100 call purchase and a 3,105 sell. This is the same thing as buying the vertical spread. The interface just helps you out a little bit here. So I'm going to click on this spread to purchase it, 3,100, 3,105, and now you can see the price of this is anywhere from negative 2.65 to 2.9. This price that it shows basically comes from the difference in the 3,100 call and the 3,105 call. Each of those strikes have a bid and an ask price, and the spread on those is a little bit varied since we're so far out of the money here with Amazon. And so the spread on this vertical spread transfers over the same. Remember that all we're doing is buying a 3,100 call and selling a 3,105 call. So we're playing with those same bid and asks. The interface is just combining it together for us. So typically when you're buying vertical debit spreads, you want to buy at around the mid price that it shows you here. So you can see once you click on it, it actually gives you the mid price down here in the bottom right corner, and these are only 13 cents. Now sometimes when the bid and the ask on these vertical debits are so far apart, you're not actually going to fill at the mid and you might have to go a bit higher. So for something like this, I might be looking for, let's say, a 1.0 price. So as soon as you go to buy this, you can see that it tells you the cost of the trade, $100, which is the 1.0 times that options contract multiplier of 100, so $100 for this. And it says max profit here of $400. For now, let's just go with that. We're going to get into where these profit levels actually come from and where we need the Amazon price to be to make profit. I'm going to go ahead and purchase this vertical debit spread at $100 here. Okay, so now I've fast forwarded to July 27th at 9:45 a.m. Let's take a look at what the spread price is now. The first thing we can see is that Amazon is now $3,085, and this is just the Monday after we purchased that spread, so it's pretty quick time frame for a turnaround here. Looking at that spread, that same 3100, 3105, you can see the bid ask is now 0 to 3.3, or in other words, the mid is around 1.65. Now we paid 1.0 for this, although the mid was around 13 cents, so it's hard to know in real time where we would have gotten filled on this, but you can see that it's definitely higher now. And that's because Amazon's gone up $100. We're closer to that $3,100 price that we're targeting. So even though these are really close to in the money now, where they would be in the money at $3,100, above $3,105 would be even better for us, we're still really far from the expiration date. With a vertical debit spread, once you're in the money on these, time is actually in your favor, and that's one of the major benefits of these as well. Once Amazon goes above 3105, we're really just waiting on time for these, which is where our max profit would come in. And I'll show you that in just a few here. Okay, so the last step in our trade here, I fast forwarded to the expiration date, July 31st, at the end of the day here. Now we can see that Amazon is well above that 3100 and 3105 price that we bought the spread for, and it's at 3162 right now. And if we just check the price of this spread, you can see the mid is right around 5.0. Actually at 5.1. That 5.0 level is actually the full value of these contracts. When we bought it, we saw that the max profit was $400, and that's because we paid $100 for the contract. So if we just do the math on that, if the contract's worth 5.0, we paid 1.0, that means that the max profit would be 4.0. In other words, the max that these can go to is 5.0. So let's summarize the profit or loss potential on these using that $3,100 and $3,105 strike price that we bought. I'm going to be speaking about intrinsic value on these contracts, which is basically just the real value of the contracts. The other side of the value is known as extrinsic value, and it's the time value of the contracts. When talking about intrinsic value, it's really important to remember these contracts are just giving us the ability to buy or sell 100 shares of Amazon at the strike price that we've chosen. So let's just start off with the worst case example here and say Amazon did not get above $3,100 before our expiration date here. Let's say we closed today around $3,000. Let's think about what that means for our contracts. We know we bought the $3,100 contract, which gives us the right to buy Amazon shares at $3,100. If Amazon's currently $3,000, that contract is obviously worth $0. We can't sell it for anything. On a similar note, we sold the $3,105 contract, which again, just like the $3,100 contract was worth nothing, this one's also going to be worth nothing. Therefore, both of these contracts are worth $0. We can't do anything with either of them. We lose our premium that we paid to take this trade, which was that $100 cost. Now let's go back to our best case scenario, where Amazon is above $3,105. Let's just say we closed at $3,110 just for easy math here. That $3,000 call we bought is now worth 10.0 or $1,000 because Amazon is $10 above and we're able to buy 100 shares of Amazon. The $3,105 call that we sold similarly is worth 5.0. However, we sold this. Someone has the right to buy these shares, which means we actually lose $500 from that contract. So if we put the two of those together, we gain $1,000 from the first contract, we lose $500 from the second contract. Our overall gain is that $500 that we can see as our Amazon contract price right now, and then we subtract the premium we paid, which is $100. Our total profit is $400. No matter how far above 3105 we are at the end, the math works out exactly the same to where we earn that $400 profit. In the very last case scenario, let's say we close somewhere between 3100 and 3105. Let's go with 3102. Our 3100 call contract is now worth 2.0 or $200, and 3105 call contract is now worth $0 because why would you buy Amazon at 3105 when it's at 3102 currently? So the one we bought is worth $200. The one we sold is now worth $0, so we don't owe anything back on it. We gain $200 minus the premium we paid at $100. We gain an overall $100. So let's summarize the profit and loss potential of vertical call debit spreads that we've gone over today. The three options once again. First, we're below both of the strike prices. In this case, we lose the premium we paid, and that's our maximum loss, no matter how far below we are. 2, we're above both of the strike prices that we bought. In this case, our max profit is earned, which is just the strike prices subtracted from each other, and then subtract the premium as well. So in our previous example, our strike prices were $31.05 and $31.00. That means we do $31.05 minus $31.00. That gives us 5.0 minus the premium of 1.0 gives us 4.0. No matter how far apart your two strike prices are or where the price ends up, this is always the max profit. Higher strike minus lower strike minus premium paid. And the third case scenario is when we're between the two strikes. To figure out our profit or loss for this, we do the closing price minus the lower strike minus the premium we paid. So in our example, the closing price was $31.02, the lower strike was $31.00. $31.02 minus $31.00 is 2.0. Subtract the premium that we paid, which is 1.0, and we earn 1.0 profit. Vertical call debit spreads are really great for managing your risk properly. Even though it limits your reward, your risk is capped, and also for entering trades that would just be way too expensive for you otherwise. I hope this helped you, and I hope you can use vertical call debit spreads in your trading. If you like this video, please do click that like button and hit subscribe below. I really appreciate all of your support.